Okay, students, we will continue on with liabilities. Now, at this point, there is a concept review exercise, and I encourage you to spend some time going through that, making sure you understand everything about what we've covered thus far. But I'm going to move on. I'm not going to go through that. That's for you to do on your own. Now, contingencies is the next category of liabilities. Now let's think back again to the definition of a liability. In order to be classified as a liability, something must be past. It must arise from a past event or transaction. Present must be a present obligation. And future must be a probable future sacrifice. Now that word probable is important. It means likely to occur, or it will most likely occur. It's probable. So contingencies are situations where we are not absolutely certain that we're going to have to make a future sacrifice. And in fact, the accounting standards have defined that future sacrifice might be either probable, reasonably possible, or the probability may be remote. Now, I'll come down here and talk about these in a minute, but those are the three categories of risk associated with the future cash flows. So, what are examples of contingencies? Well, they're all over the place. A lawsuit is an obvious one where someone has sued you. Do you have a liability? Well, the answer is, did it occur from some past event? Well, if the answer is yes, and usually if you're being sued, there is some past event that gave rise to that. So maybe it's a past sale and they're arguing that you didn't deliver what you were supposed to deliver. And so it arises from a past event or transaction. Is there a present obligation? Well, maybe. Not 100% certain there because the existence of that obligation is somewhat dependent on some future event that may be beyond your control, like the outcome of a lawsuit. And will it require a future sacrifice? Well, again, that's uncertain. So we have to determine what is the probability that we have an obligation that's going to require a future sacrifice. Now, if the answer is we think it's remote, we did nothing wrong, their lawsuit is frivolous, this person is known for launching frivolous lawsuits to just try and get a settlement, and they have no basis for a claim against us. We say, okay, the probability we're going to have a loss is remote. Then you're not even required to disclose that. Now, reality is most accountants are going to probably still disclose something about it, but you're not required to. Now, reasonably possible, let's say we say, okay, it's reasonably possible. Now, what does that mean? Well, it means, yeah, we don't know what juries will do. There's it's better chance than remote, but it's certainly not probable that we'll lose. Under that case, you have to disclose the contingency, but you do not have to record a liability. Now, let's say that something happened and we know that we are going to be held at fault, or avoiding a lawsuit, getting away from the lawsuit. What if it's something like a warranty claim? And so we sell $1 million worth of goods that we have issued a warranty, and we know historically that 3% will be presented for warranty claims. And so our warranty claims will be about 3% of sales. So we sold $1 million worth. Well, 3% of that is $30,000. So we come up and say, is it probable that we're going to have to make some future sacrifices to make repairs to things we warranted? The answer is yes, it's probable. Can we reasonably estimate the amount? Yes, we think it'll be about 3% of sales, $30,000. So in that case, we actually have to record a liability. So we would debit warranty expense and credit contingent liability or warranty liability for that amount. Then as claims are made on the warranty, we would debit the liability for warranties, and credit cash or whatever we had to provide to take care of those warranties. So if a contingency is both probable and we can reasonably estimate the amount, then we have to accrue that liability. So we debit a loss or an expense, credit the liability. Okay, if it is probable but we cannot reasonably estimate the amount, then we have to disclose it, but we do not record a liability. Now, quite commonly, you can estimate the liability within a range. So let's say we think it's probable we'll have a loss, but we don't know what the loss will be, but we estimate it will be in the range of $200,000 to $300,000. In that case, we do record a liability because it's probable that we're going to incur a liability, and we can reasonably estimate the loss within a range. Now, at this point in the class, if we were in class, I would ask the question, okay, in that case, how much should the liability be? Should we record a liability of the minimum amount of the range, $200,000, the maximum amount of the range, $300,000, or should we just go to the middle, $250,000? And then I would ask the class to vote. Now, when I've done that, and I've done that pretty much every time I've taught this class, think about it for a minute. Which way would you vote? Now, usually what happens, there's a pretty good chunk that votes for the maximum amount, $300,000. There's a pretty good chunk that go for the midpoint, $250,000. There is a group that doesn't vote, and I don't quite understand that, but because you're not ever going to get it right if you don't try. But anyway, which one of those would you say? Or would you say the minimum amount, $200,000? I'm not sure if I threw that out. Well, the answer is you actually accrue it for the minimum amount of the range, $250,000. Now, that may seem like it's unreasonable compared to the way GAAP handles most things, but you have to think back to revenue recognition. And remember, with revenue recognition, where there was returns, we couldn't recognize revenue until we could reasonably estimate returns. And do you remember what the reason for that was? Well, I hope you do. But if you can't, the reason was because the FASB did not want someone recognizing revenue in a current period and then having to unrecognize that revenue in a subsequent period. Well, the same thing is kind of true here, but in reverse. the FASB came up and said if you can only estimate within a range, then you estimate the low end of the range. Because let's say we recognize the revenue the liability this year. What's our journal entry? We debit a loss or an expense. We credit a liability. Now, let's say next year, so we estimate it, and let's say we go to the high end and we estimate, say, okay, we think it's in a range of 200 to 300,000. If we were to record the $300,000 liability, and then we settle it for $220,000 next year, how would we record that? Well, we credit cash for $220,000. We debit the liability for $300,000 to get it off the books because we no longer have a liability. And then what do we do with that other $80,000 credit? Well, the answer is we would either have to credit revenue or credit an expense. Well, neither one of those is really true. We didn't have revenue from that. And we also didn't reduce expenses in that year. So the idea is they don't want us to over-recognize an expense in one year and then reduce expenses in the next year because we recorded too much expense in the previous year. So in this case, with our estimate, we would, when we can only estimate it within a range, we record the bottom end of the range. And then next year, if we record $200,000 this year, and next year when we settle it, we have to record an additional $20,000 expense. Well, that's just the breaks, but we had to do something. Now, under IFRS, you would actually record the midpoint of the range. So you would record a liability in the first year of $250,000. So that's a difference between U.S. GAAP and international GAAP. And again, remember the three categories. Probable means it probably will happen, most likely will happen. What's the percentage? We've talked about probable before. I don't know, 75, 80%, something like that. Reasonably possible is probably anything in the range of maybe 25 to 75 or 80%, and remote would be something where there's probably less than say approximately 25% chance that it will occur. Now those chances are things we just make up, but that's kind of the philosophy there. And notice down here what I've highlighted in this pink color and underlined in red to make sure it stands out. A liability is accrued if it is both probable that the confirming event will occur and the amount can be at least reasonably estimated. So again, you can see how I've marked this up, but if you have any questions, feel free to call me or send me an email. And right here, notice a loss contingency arises when there is uncertainty about whether a past event, this has to be something past, will result in a future loss. The uncertainty will be resolved only when some future events occur. Okay, now some people want to set up a liability. Let's say you open a restaurant, and if you open a restaurant, you serve enough meals, eventually somebody's going to get sick and claim it was your food. And so some people say, well, let's just set up a liability to handle that. Well, no, you cannot do that because you can only recognize any kind of a liability when something has already happened. It has to be the result of a past event or transaction. Okay, our time for this video is just about up. We will start the next video by moving on down. and finishing off contingencies.